Jeff, good to see you.
Great to see you, Melissa.
So are you in the camp that the 10-year yield is actually sort of capped?
I think it is, Melissa. And let's just rewind for a second. And I appreciate the lens we were just looking through for the Bank of England. But to put it in context, the Bank of England intervened and bought about $15 billion worth of bonds. We've bought and we currently hold on our balance sheet $5.6 trillion worth of treasuries. So as our $8.8 trillion balance sheet is really in a movement here, think about what transpired in the 10-year note or the 2-year note we'll get into as well. But the 10-year went from 1.5% to start the year to over 4%. That rubber band was stretched and the yields were compressed and intervened so much by the Federal Reserve. It was unorthodox. It was unnatural to see this supersonic move of rates normalizing. That's what's causing all the problems. I go back to where I cut my teeth, as you know, the Chicago Board of Trade, the CME group, and I utilized the bond leadership. And it is relevant today. Look what happened when we saw the sentiment number out of the University of Michigan. It moved the 10-year note from 3.84 up to over 4%. What happened to equities? We saw equities get sold off. So the bond leadership is in context. But when I talk about sustainability, Melissa, I don't think it's sustainable. And I think the Fed once again mismeasured. They thought they were going to have a lot of buyers lined up. If you look at the 2-year note, the 2-year note is a great way to look at the front end of the curve. It was at 35 basis points just 52 weeks ago. Yeah. Now above 4.5%, Melissa. I think the Fed really mismeasured. They thought they were going to see buyers in the front end of the curve at 3%, 3.5%, 4%. We did see an institutional buyer come into the markets yesterday, substantially buy the yield at 4.5%. And remember, of course, that yields are inversely related to the futures prices, but it's a fascinating concept right now, and I don't think it's sustainable for so many different reasons. But look at the expense that the Fed is enduring on their balance sheet. We're talking about, and this was the Congressional Budget Office. It's not Jeff Gilbert coming up with this statistic, Melissa, but we're talking about the interest on our new cost of interest going over $400 billion, and over the next 10 years, that's going to vault over $1 trillion. So my thesis of it not being sustainable brings the 10-year back down. It also brings the front end of the curve back down. And the Fed does have the tools to move that curve. So
in a world in which the 10-year yield is capped, Jeff, is that a world in which equities go higher? Or is that a world in which there is stagflation or severe economic slowdown and the markets do not go higher?
I think you hit the nail on the head. I think this is a wonderful opportunity. Last year, I banged the drum how many different times moving out of growth to value. We talked about the essential names, these blue chip tangible names. Now I really think you have opportunity as you saw the rates move in such a way. And I've been trading these markets and these futures for a long time. Never seen rates move like this, Melissa. So that presents an opportunity for technology, specifically semiconductors, which have been absolutely abused. Look at NVIDIA. Look at Broadcom. Look at even Intel, which, arguably could be bought by AMD. But nonetheless, you're seeing an opportunity and a discount in all these rate-sensitive names. And you're seeing that uber sensitivity just in the depiction today when we saw the market, specific to the 10-year, move from 384 up about 4%, and all of a sudden technology got hit again. So I think this is the time between now and the midterm elections to really embrace the fact that there's some great quality companies in technology, in semiconductors, that you've seen all the bad news priced in my opinion.
So I got to ask you as a Treasury futures guy, so is there an opportunity in just trading a band? The 10-year yield hits whatever percent, and you're out.
Yes, absolutely. I think the front end of the curve, I think 4.5% is where we'll see a cap out, so you can buy those treasuries, which are inversely related. But also in the 10-year note, we need to see some type of catalyst for them to really abate. I'd like to see it get under 375, and technically there's a lot of back and fill in those yields much lower. We could see by the end of the year the 10-year under 3.5%. That's very counterintuitive to what the Fed wants to do. But once that Fed, we don't need the Fed pivot. I know that word has been used ad nauseum, Melissa, but just a Fed exhale or a Fed pause, that will move rates lower, and that will let equities come back. And that is maybe, Mel, the midterm, late in the year election rally that a lot of people have been talking about historically for the last 85 years.
Shepard Smith here. Thanks for watching CNBC on YouTube.